Joining me right now is Altium Wealth Portfolio Manager, Market Strategist Michael Lee. Michael, it is good to see you this morning.
Thanks for having me.
How would you be positioning yourself ahead of what is a big week at the Federal Reserve, the jobs number out at the end of the week, and, of course, the earnings period?
Well, look, I think you got to have exposure to U.S. stocks. It's just a matter of how aggressive you want to be. What I'm looking to this earnings season is, are we going to punish all the losers the same, or are we going to reward the winners? Is there going to be a diversion between winners and losers, or is everything going to move in unison like we did with the last quarter earnings, where we had that pretty horrific sell-off at the end of the third quarter going into the end of the year?
Yeah, but I mean, you see a change in this market with the Federal Reserve on hold, correct? Friday, we get an article in the Journal basically saying, look, they may not necessarily only be on hold for raising interest rates. They may actually even be on hold in terms of the balance sheet unwind. Is that a positive?
I think that would give you a short-term benefit, but in the long run, I think that would be horrific. I mean, your playbook for that is Japan. You had some great interviews last week, especially with Ray Dalio, talking about the little gunpowder that the Federal Reserve would have left if something bad were to happen. So if the Fed stops raising rates, if the Fed stops reducing their balance sheet, if we do have a downturn, I don't see any point in the near future. But if something does happen, some external factor slows down our economy, what is the Fed left? What do they have left? What are they going to do?
There's not a lot of wiggle room. That's the whole point, right?
Because
the Fed does not have wiggle room after having rates at 0% for so long.
Well, and to put it in perspective, the Fed funds is now where it was in 2008 when Bear Stearns went under. Okay. In addition to that, we have a $4 trillion balance sheet. So what can the Fed really do, right? What will be the net effect if we took the balance sheet from $4 trillion to $6 trillion and we took rates from 2.5 to 1?
No, they're talking about taking the balance sheet from $3.5 trillion to maybe $2.5 trillion, as opposed to, $1.5 or something. I mean, they're not talking about going up to $6 trillion.
Yeah, well,
they're talking about going down.
No, I'm speaking theoretically. Okay. I'm just saying if they were to stop reducing the balance sheet, you further reduce their power in the event of another downturn. So I think the playbook for not doing anything in terms of tightening is Japan. And I would make the argument that the Fed hasn't really tightened. Commercial and industrial loans are up 10% year over year. M2's up 5%. So we're not really there yet. So I think the market became too myopically focused on the Fed's balance sheet reduction and rate raises in the event that this would somehow slow us down. We're a long way from normalization. I think the Fed should continue reducing their balance sheet, and every time the long bond gets below 3%, it's like, I don't know why they're just hitting sell.
Let's talk about this week, because it is a big one. 22% of the S&P 500 has reported their fourth quarter already. 73% have beaten earnings expectations, and we got a pretty good start to the year. Take a look at this market. Dow Industrial seeing the biggest winning streak since August, just in 2019. Do you like this? Do you want to buy into it?
Yeah, well, look, I'm very bullish on U.S. stocks, because I think growth estimates, earning estimates for going throughout 2019 are too low. Okay, part of the reason they are low is people are looking abroad and saying, hey, growth abroad does not look that good. Well, part of the reason growth abroad does not look that good is because we have had massive structural reform in the United States, both from a tax standpoint and from a deregulatory standpoint. So investments in the U.S. are far more attractive now than they were 18 months ago. This is going to pull growth from the rest of the world in the short term into the U.S. So the growth estimates of low 2% GDP growth for the U.S. basically assume no multiplier on the tax cuts, and that this was a one-time sugar high. I just don't buy into that.
All right, so you want to buy stocks here. And even though mostly it's unanimous that we're going to see a growth slowdown, we've got Caterpillar reporting earnings this morning. Earnings a year ago were $2.16 a share. We're looking at an estimate of $2.99. The stock is up 11% from a year ago. In terms of, it's up. Earnings would be up from a year ago, 11%. Apple is also reporting tomorrow on Tuesday. You want to buy Apple ahead of their numbers?
Well, look, Apple's been crushed based on that announcement. It'll be really interesting to hear what they have on that call.
All right.
It's really hard to get involved in individual names.
Yeah.
Especially
so you want to go with
in earnings
ETFs
season.
At this point? ETFs? Or
a big proponent. Like, you can just buy the S&P 500. The chance of you picking, for an individual investor, the chance of you you picking a name ahead of earnings and then having that benefit to you.
I get that.
Well, it just, you could be 100% right on the earnings call, and then the market could go the other way.
Let me ask you about the IPO situation. The government open now for the next 3 weeks before the next funding deadline. We've got a window for companies who want to go public that faced a setback with the shutdown because the SEC obviously was closed. Bill Smith over at Renaissance Capital thinks we're going to have a wave of biotechs coming in this next 2 weeks. Of course, we've got a whole host of companies on the horizon that we're expecting for 2019. But there were two companies that basically filed to go public under a rarely used rule, even though the SEC was closed. That was New Fortress Energy on NASDAQ and Gossamer Bio. But he thinks biotechs are going to use this opportunity for this next 3 week period and try to go public. What do you think about the IPO? What is that story telling us?
So there's always an appetite for investors to get into IPOs, right? The issue is on the issuer side, in that if I'm trying to go public in a sector where multiples just went from 15 to 10, that's not where I want to go public. So the biotech stocks, having rallied significantly in this comeback early this year, is going to open that window. And then I think, the appetite later into this year for Ubers and Lyft and Palantir, this is going to be a good year for IPOs, which again I think is another positive overall sign, not only for U.S. markets but for the U.S. economy.
I was surprised that so many IPOs came to market. Even last year, when we had such a difficult end of year, it bodes well, right? I mean, it looks good for the market if a company is willing to come public, even though you've got a troubled market. Yeah,
well, look, like I said, the appetite is always there because an IPO is invariably going to price slightly below where the market is. So by getting involved, an investor getting involved is always going to want to get as many shares of an IPO as possible. It just has to do with the overall valuation of that sector, so that the issuer gets paid for when they go to market.
All right. Well, markets are down today, but you're bullish. I like it. Michael, it's good to see you.
Thanks so much.
Thank you so much. Michael Lee joining us.